Big news out of Alberta yesterday. Imperial Oil, the big oil sands company, announced that it's going to be laying off 900 workers, which is about 20% of its Alberta workforce. Um, they're going to close their Quarry Park campus, so that's where a lot of the engineers and other technical people were employed. They're going to transfer the rest of the workers up to Edmonton, and all of the technical operations that were done in Quarry Park will be transferred outside of the country, presumably down to Houston, where it's the biggest shareholder, ExxonMobil, is located. So that's big news. But why should you care? This is important, and I'm going to explain it. First of all, we want to say, extend our sympathies to the workers. That's a tough situation to find yourself in, getting laid off, and as the global economy softens, and it's going to be tough on the Calgary economy. But there's a bigger issue here that's part of the national conversation around projects of national interest. Those are projects that the markcarney government wants to move forward and approve them in 2 years, get them built in a hurry. And one of those is an oil pipeline to the West Coast. Could be Kitimat, where the Northern Gateway was supposed to terminate, or it could be Prince Rupert, which is Alberta Premier Danielle Smith's flavor of the day for a destination. But whatever, a pipeline to the West Coast to get Alberta oil sands bitumen over to Asia, particularly China. Here's the problem. As the Imperial Oil situation, their announcement shows, it's quite possible for the oil sands companies to reduce their workforces while increasing production in the oil sands. In fact, and I know you're going to say, well, no, that's not going to happen. If you increase production, you need more people to do it, right? Not necessarily. The historical trend since 2014 is that the Alberta oil production has risen. It's been tripled. It's now about, I guess, just over 4 million barrels a day. And the oil sands accounts for 3.5 million barrels a day. So it's tripled. The workforce, meanwhile, over that period fell from 178,000 to 145,000. So basically 33,000 jobs were lost as the industry increased production. And I'm going to argue that this is really the Imperial Oil may represent the tip of the iceberg. And if that's the case, and I'm going to lay out the numbers here in just a moment, then the federal government should really, really reconsider whether or not it wants to approve a pipeline. So let's get into the data and the evidence. The first thing is Tim Hodgson is the Minister of Energy, Federal Minister of Energy, and he put out a statement on Twitter, and here's what he said. He said, first of all, he was deeply disappointed. Fair enough. And then he said, Canada's new government is laser focused on building new major energy projects, supporting energy workers, irony, and unlocking new export markets for our resources so we can become an energy superpower. We are taking steps today to ensure the Canadian energy sector will continue to provide careers and prosperity for generations to come. This Imperial's announcement is a big embarrassment for Hodgson. Ever since he was appointed energy minister 6 months ago, he has been promoting the expansion of oil and gas, LNG on the West Coast, expand the oil sands and build a pipeline. He's been promoting that to anybody that will listen. And no wonder he's disappointed. I mean, it really is kind of an arrow in the heart of his argument. So that's part of the issue. Now, I want you to watch this interview I did with Alberta Federation of Labor President Gil McGowan. I caught him in the Vancouver airport last night, got a comment from him, and he hits on something that gets to the heart of my argument.
Boom times are over. We're in harvest phase, and Albertans need to get their heads around that because the oil industry will not be the same kind of engine for job creation as they were before. And I think, as Albertans, as the owners of the resource, we need to start asking ourselves, is this the best deal that we can get for the extraction and development of our publicly owned resources? And if this is going to be the future, where are the jobs going to come from? Those are the kind of questions that we need to be asking ourselves in the wake of this announcement, this very devastating announcement from Imperial Oil.
So what McGowan is saying here is that essentially the oil and gas industry is now mature. It's coming up to maybe peak oil demand. It's doing what all mature industries do, which is they become more efficient over time. They raise productivity by replacing workers with technology. And in terms of, maybe coming to peak oil demand, here's a column from Reuters by Ron Busso, and this is from March 26th, and it's a real insight if you can find it. It's called "Welcome to the Age of Big Oil's Managed Decline," and what Busso argues in here is that the super majors, ExxonMobil and Chevron and Conoco maybe and Shell and so on, they know what's coming, and they are preparing for an oil market after 2030 that is lower for longer, maybe probably permanently lower. And so what they're doing is they're shedding their high cost production fields of oil and gas, and they're crowding into fields like in Guyana, where break even is around $30 a barrel. That's pretty low. And you can be competitive for a long time, while higher cost producers like the American shale, which is $65 or $70 a barrel, maybe fall by the wayside. Now, the interesting thing here is that's not the language, that's not the narrative that the global industry is talking about. ExxonMobil's CEO has been in Alberta talking about how it's going to be, a golden age of oil, and we're going to see an expansion of oil demand out to 2050. OPEC has modeled this, and its Secretary General Haitham El Gai also been in Alberta, is saying, look, we had it, it's expanded in the future or in the past, and we're going to see exactly the same trend. There's no reason why it should stop. So even though the smart money is preparing for the worst case scenario, the public face of all of this is no, 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 everything's great. We're going to have expansion. The industry's never been better. Okay. Here's what the problem is. So I've set out the argument: the oil sands production could increase substantially, but employment continues to fall. Imperial's announcement is all about efficiency and costs and return to shareholders. Now, look, you've probably seen some of my interviews with S&P Global energy economist Kevin Byrne, who's been following the oil sands I've been interviewing for a decade about it. So it's been a long time. And he's put out various reports on the cost of production per barrel. And he's told me for years now, the oil sands producers are pursuing production efficiencies. So you invest in, like for instance, in Suncor's base camp, you've got a massive boilers to create the steam used in oil sands extraction, and it was being done with petcoke, which is expensive, very carbon intensive. Shift to natural gas, you now become more efficient, your costs come down. Okay. And they're doing that all over the place. Now, in 2018, when I was writing my book, The New Alberta Advantage, Technology Policy and the Future of the Oil Sands, I interviewed the then director of IT for Husky Energy, which has since been merged with Cenovus Energy. And what he told me it was almost science fiction at that time. He said, AI is going to revolutionize the back end of the oil company all around the world. He said, think about it. If you have a filing clerk, well, once the files are all digital, AI will do that. If you need a legal brief, and now you get a paralegal or a junior lawyer to do it, you just tell the AI what you need, and it will search the digital law books, and it'll come back with a brief for you. And all throughout the back end of the operation, AI is going to eliminate many of those low to medium value, from their point of view, workers. That's coming. It's begun. And I think that is part of what is motivating Imperial Oil here. They have these big global centers, technology centers where they crunch data and et cetera. And they want to move the Alberta operations, the data crunching, someplace where it's cheaper. Maybe, they have new technology or just, it's an issue of scale. Who knows? But that is where the industry is going. So what's happening at Imperial today is already happening to the other companies, and there are five or six other oil sands companies of note. It's already happening. For instance, Suncor, they've switched to autonomous ore haulers in their mines up in northern Alberta. And we're going to remote measurement and remote surveillance of wells and operations, on and on and on. The new technologies that are revolutionizing the world we live in, why would we be surprised that they're not revolutionizing oil production? The oil and gas industry is adopting those technologies to lower their costs, increase their efficiency, and become more competitive. And they're anticipating a more competitive global market. Makes perfect sense. So from that point of view, Imperial Oil is doing what big companies have always done. Exactly what I just described. I mean, it's kind of it's not a bug, it's a feature. That's what they do. But why are they so focused on efficiency and lower costs now? Because there's another driver here that I want to talk about. And you've probably seen my interviews with University of Houston economist Ed Hurst. And Ed makes the point over and over and over again that the global oil and gas industry has underperformed relative to other sectors. So if you're an investor and you're looking to park money, especially if you're a big institutional investor, maybe, you would probably want to put your money in tech or biohealth or something like that rather than oil and gas, because the oil and gas returns are lower. So what that's led to is investors who are willing to invest in companies or lend money to oil companies is they want higher returns. There's a lot of pressure to increase dividends and to do more share buybacks, which supports the stock price. And that is playing out in the Alberta oil sands in spades. Because I didn't do this year, but I did it last year. I was looking over the oil sands company's investor presentation, what they tell investors, and they give them a lot of information, a lot of technical data, and so on. And one of the things they said was, "We will promise you 75% of our free cash flow." So think of, it's not exactly the same, but think of it as net income. It's the money they have at their disposal after they paid all their expenses. We'll give you 75%. And some of them said, we'll give you another half of the last 25%. So roughly, 85 to 90% if the market's good and prices are high. So the oil sands companies are under enormous pressure, as are all oil companies, to return capital, return money to investors, to shareholders. And you see that's exactly what the CEO said, the Imperial Oil CEO said. He said, and I'm quoting here, "The layoffs will enable Imperial to further enhance cash flow growth by driving productivity improvements across the operation." And then there are other comments in the release that are, back that up. So this is the dilemma that the industry faces in that it's got potentially peak oil demand in 2030. It's got pressure from shareholders. It's got pressure from regulators about high greenhouse gas emissions. It's got pressure to lower it's got an opportunity to use new technologies to lower its costs and increase its efficiency. And that's what it's going to do. But who benefits from that? Well, clearly not the workers, but this is interesting. Over 80% of oil sands production is owned by Canadian-based companies. But what percentage is owned of those companies are owned by Canadians? Well, as it turns out, under 50%. Now, there's some dispute about the numbers involved here. I want to make that really, really clear. And the organizations that that publish these are generally, environmental groups, climate groups, and that kind of thing. But I think based on what I've seen over the years, about 70 to 75% of all the shareholders in the oil sands companies are foreign. They're non-Canadians, and probably the biggest chunk of that by far would be Americans. So here we have an American-owned Canadian company laying off people and all, at the same time uh, promoting expansion of its operations and the oil sands in general, construction of a pipeline. So the shareholders clearly win. The uh, the management team clearly wins. Uh, who else wins in this scenario? Well, let me tell you, governments. The uh, Alberta bitumen royalties, 2018, 2019 were $3.2 billion dollars. By 2023-24, they had risen to $17 billion dollars. Now they're going to fall this year. And they might even fall further. But the last estimate that we saw was about 12.8 billion. That's a lot of money. That's a big, big chunk of the Alberta budget. And I think if I remember Danielle Smith's comments, it's likely that Alberta is going to run a deficit this year because it won't be receiving the kind of royalties it had anticipated. The federal government, and this is a more difficult number to calculate because it's taxes. And so you get direct taxes from the oil and gas industry, you get indirect taxes, you get taxes from induced employment, on and on. But generally, probably about $3 to $5 billion a year. What government doesn't need more revenue, right? I mean, that's one of the reasons why the NDP in British Columbia have suddenly become, massive supporters of LNG, is because they want the royalties and the tax revenue. So this is the problem here, is that we've got self-interested parties who are pushing this agenda and, kind of neglect some of their own, to describe their own or declare their own self-interest, which, they probably should. Um, and we have a lot of risk attached to this because I think it's a fair bet that by between now and 2030, we'll lose more oil and gas jobs because of new technologies, and that trend will continue into the 2030s. So you have more production, you have fewer workers. Yes, you have more tax revenue, but that's not the bargain here. There was supposed to be employment and business opportunities and so on. That doesn't seem like it's going to happen. But it introduces risk, and it raises the question of should the federal taxpayer risk public dollars supporting the construction of a pipeline to the West Coast to significantly increase the production of the oil sands, which would be about 700,000 barrels of bitumen to fill a 1 million barrel a day pipeline that's been talked about? Probably not. I would argue that this trend, illustrated by what happened with Imperial Oil, introduces a significant risk factor that we have not talked about. And clearly, based on Tim Hodgson's comments, the federal government hasn't integrated into its calculations yet. So we're going to continue to follow this story. But I think this is the frame here. This is the frame. Growing production, falling employment, and fewer benefits of more expansion. This idea of becoming an energy superpower while we're shedding jobs is kind of silly. And I've argued in other videos that Canada will never be an energy superpower. In fact, the phrase is meaningless. But we're going to follow this story and we'll continue reporting on it. So keep watching.